Hey, good evening, everyone, and welcome to tonight's live stream. It is almost upon us Christmas, and I'll be doing one more live stream after this. And I think I'm going to take a break because I think you're all just too busy, and I don't want to take up your time during this busy holiday season. Tonight, we're going to be doing I think a really important, very brief video on tax planning tips, year-end tax planning tips. This is always kind of like a good reminder in terms of what you need to be thinking about before the year is over. Is there anything last minute that you can, quickly do to make sure that it helps you with your tax? And of course, this year was particularly interesting given the markets have gone up so much that people are probably scrambling to figure out what to do and how can we save money in tax. So that's what we're going to talk today. Real quick, if you can hear me, please somebody give me a thumbs up or a yes, we can hear you just fine in the comments. This is live streaming across Facebook, LinkedIn, and YouTube simultaneously. The video will be saved on YouTube and gets deleted off of LinkedIn automatically after 2 weeks. So I hope you're doing well. Good evening. My name is David Aaron. I provide all kinds of information around financial planning, retirement, life insurance, and for business owners, for individuals and families. I love doing this. I love getting your questions, and I look forward to getting your questions. You can put all your questions in the comments below during this live stream. If you're watching it on the repeat on any one of those social media accounts, just go ahead and put your comments in, and I'll reply to every one of them. If you have any questions or any comments about what you'd like to see in future, please let me know. I'm happy to do videos if it's possible to do those videos. So why don't we get right into it? This is going to be a very good, very informative, no selling here. It's all about your education and how to help you while you are trying to save and invest your money. So let's dive right into this right away, okay? And I hope you're doing well. I hope you're all safe and you're getting through the holiday shopping. I would be interested to know if any one of you who are watching tonight that you can maybe put in your comments, are you doing more online shopping or in-person shopping? And have you had any difficulty finding what you want to, buy? I know from my firsthand knowledge going into a menswear clothing store, Harry Rosen, I'll give them a plug. No endorsements coming from them. I'll give them a plug. They had a lot of selection, but the variety wasn't really there in terms of my size. So I ended up having to ship a couple shirts to me rather than being able to just pick them up in store. So that's what I've noticed. So still could see what I wanted to purchase, just had to be shipped to me. So I wonder if you could put some of your comments in there. That'd be interesting to know your feedback. One other point to mention is go ahead on my YouTube channel under the community tab. There is a brief poll there that I'd love for you to participate in. It doesn't tell me who participates in it, so your information is kept confidential. Okay, so let's dig into this right away. The first thing you want to do, year-end tax planning, revolves around your financial plan. Now would be a good time just to quickly review that financial plan, take out what you had planned on doing from the beginning of the year, because generally speaking, and I just love that saying that I have on there, seeing the outcome of your planning decisions before you commit to them. So at the beginning of the year, you had a one-on-one, your annual review with your advisor, and that's where you kind of mapped out what we expect to do over the course of the year, update your financial plan. Now would be an interesting time just to break it out and have a look, reflect on the previous, at the beginning of January, look at your investment accounts, look at your debts that you paid down, everything that you were trying to do, and see where that matched up. Were you any close, or did you overachieve on some of those goals ahead of making? So why am I putting this in? Because it really is revolving around the fact that I want you to book your next meeting, if it hasn't been done already, with your advisor to do your annual review. So this is usually you set up like your next meeting with your advisor at that particular event. But if you haven't, it's okay. Now would be a good time to use, for instance, my clients, they could go online and book all their annual reviews with me online on my online calendar. So it's pretty simple to do. they'll schedule in their date and their time. And it's great for me because it saves a whole lot of work. They've gone ahead and scheduled their date. So that's the end of year thing you want to do, is make sure you schedule that meeting with your advisor. That's going to probably be in January or February ahead of the RSP season, right? Makes sense, right? Okay, on to the next slide. Okay, set up a mini-RRIF, that's RRIF, Registered Retirement Income Fund, for ages 65 to 70. Well, this is kind of, has anyone ever heard of this before? Because this is kind of an interesting, it's not a concept, but it's something that you ought to pay attention to, because it really is revolving around a very specific age group. And I'll share with you exactly what that means. So if you are ages 65 to 71, this is your opportunity to do this. And what it really means is, oh my goodness, a commercial coming in there, is you have an opportunity actually in the year that you turn 71. So let's say you turn 71 this year and you're thinking about making an RSP contribution. So you can make an RSP contribution in the year that you turn 71. The idea, though, is that you have to convert your RSPs to a RRIF, because that's the law right now. And so this would be interesting for you to do that. But one of the issues that I want you to pay attention to is being able to take advantage here of a tax credit. So what you would do is you take some of your money and you would take from your RSP and deposit that into a RRIF. So let's say you were to transfer, let's say you're 65 years old and you're to transfer, say, $12,000 into a RRIF. And then what you would do is you would take out $2,000 out of that. And in doing so, you get a disability, or not a disability tax credit. That's something we're going to talk about later, but you would get a tax credit up to about $400, maybe even greater than that, depends on what province you're living in. And the advantage of this is because, let's say from age 65 to 71, you are to do this. So you have the $12,000 in a RRIF and you withdraw $2,000 out each year. And in doing so, you get a pension tax credit. This pension tax credit, you're going to be able to benefit from that. So assuming that you don't need to RRIF all of your money right now, that you have money that you can use to invest or to live off of, and you are going to defer your RSPs and convert those to a RRIF at age 71, well, you could peel $12,000 out of it right away at age 65 and take advantage of a tax credit you otherwise wouldn't have really benefited from. So that's one of the quick things that you could do to help you with your tax planning. Anybody have any questions about that? Let's have a quick look at some questions here. Rosemary, I'm just gonna share this with everybody, okay? David, I have some capital gains during the year with my stock trades. Should I sell the losing stocks to reduce my capital gain? Should the amount of my losing position be the same as my capital gain? Well, Rosemary, were you looking over my shoulder here tonight when I had prepared this this presentation? Because I'm actually going to get right into that. That's one of the slides that I'm going to be sharing with you tonight. So just hang in there, and I'll share that with you in a few minutes. Crystallize and capital gains in non-registered accounts. Does that sound familiar, Rosemary? Well, let's have a look at what we're talking about. So what you want to do is pay attention to one thing. So there's a distinction over the next two slides. One is the capital gains that you have, and the other one is the capital losses that you have. You know, we've experienced the markets in 2021, the markets have gone up dramatically, soaring rates. I think the TSX is up over 20% for the year, similarly to the indices in the United States. And so what you have is a couple of things here to look at with your gains, okay? One is, and this was one thing that you would want to address with your advisor in the new year, but one is you're probably overweighted in areas that you didn't plan on doing. So, you know, when you're doing your asset allocation, that is taking how much money you have to invest, how much of it's going to be in equities and how much of it's going to be in fixed income. And inside of those two categories, you have different kinds of equities and different kinds of fixed income. And you would allocate the percentage of money into each one of those types of investments. And over the period of the year, some of those investments have gone up dramatically as compared to maybe some of the other ones that didn't go up as much. And so you might be overweight, meaning outside of the risk tolerance that you had originally designed for your portfolio. So meaning if, let's say, you wanted a fairly common asset allocation is a balanced portfolio, that means 60% of your money is in equities and 40% of your money is in fixed income. But if your equities have shot up quite a bit, then you might have 75% of your money in equities right now, maybe 80% of your money in equities. And now you're no longer a balanced investor. Now you're getting kind of not aggressive, but you certainly are not balanced anymore. So what you want to do is you want to now redistribute the allocation back to down to where it'd be 60-40. Now, what is the problem with doing that? In many investments, when you go and do those, so for instance, to Rosemary's point or question, if you're going to be selling investments and you are going to experience a capital gain, then you're going to be paying taxes on that. And I'm going to be sharing with you why that might not be a bad situation for some of you. Now, understand I'm not an accountant. I'm an advisor. I help you manage your money and insurance. But these are kind of fairly common solutions. So please contact your proper tax professional. I'm just giving you some general, very good food for thought, but general ideas. So please make sure you get the proper advice. But so first thing is you're overweight. Your allocation is maybe too too high of a risk for you right now. So you need to change the allocation. That's really important going forward. And in doing so, just simply trying to make sure you have a proper risk tolerance, you end up triggering a capital gain. Now that capital gain, obviously, you're going to have to pay income tax. And so that's important for you to consider when you're doing this, that you may want to wait or you may not want to wait. That's going to be at the end of this presentation. There's only 8 slides, so you don't have to worry. It's not too long. But you have to consider, is it the right time for you to do this, or should you be doing it in 2022? And you have to also consider, I don't know what the government's going to be doing. Maybe they're going to change the tax rate on this, going from 25% to 75%. Not sure. Those things can change depending on how desperate the government is for capital, given the fact that they are borrowing so much to keep us all smiling. Okay, the next thing that you want to consider is crystallize and capital losses in non-registered accounts. So I hope you all kind of understood what I was talking about in the first part, and that one is one message. This one is something different. That is capital losses. And people say, well, David, what capital losses? The markets were so great. I don't have any capital losses. Well, maybe you don't, but you know what? There are a lot of stocks that people maybe had, or not stocks, but even funds that were more speculative and they didn't turn out, and there's some capital losses. So those things are really important as well, because now you have to think about, well, I need to crystallize those losses. And this is something that happens every single year from about the middle of December right through to about the middle of January. And that is when you'll see people, institutional investors like banks, hedge funds, they'll start dumping their the stocks, the investments that they had losses on, because what they're doing is they're crystallizing their loss so they can carry that forward into the years in which they're going to have a capital gain to offset that. And of course, those losses are going to be realized to you when you switch, for instance, when you switch from a losing fund into a different fund, that capital loss would be reported on your T3. And you can, of course, then use that capital loss going forward in order to help you with to offset any gains that you might have in the future. So I hope that helps, and I hope that answers your question. To answer your question, you really just want to contact your accountant and ask, what should I be selling now? How much should I sell? And they'll be able to help you to answer that question. Okay, Rosemary, but great question. Thanks again for tuning in, by the way. Okay, the next one is set up or make and deposit to an RRSP, that's a Registered Education Savings Plan, in order to receive the 20% grant. Now, this is actually kind of interesting for those people who haven't gotten around to doing it. it's important that you do that before the end of the year. You know, the grant that you get from the government when you create a registered education savings plan, it's not prorated. It's based on whether there's a deposit there or not. And if you make that deposit in before December 31st, then you can be eligible for the grant. Now, there's a number of different grants. It all depends on how much money, family income you have. But essentially, you're receiving 20% bonus on the deposit, on your deposit. So, I mean, that is a really a great place for you to start if you're thinking about where to put some of your money to help your kids for their education. You recall, first of all, that it's about $7,200 the lifetime that the government will be providing the grants to you based on your deposits, and that money is going to grow over time. So it's an excellent place for you to start a savings plan. The money on an RRSP, without going into all of the, you know, a total presentation on RRSPs, but the money grows tax sheltered. So this is what the benefit here is, that you are putting in after tax dollars, you're getting a grant from the government, and that money is growing all the way up to when your child needs the money, and then you would take the money out in your child's name so that they pay less tax. Pretty simple, not complicated stuff. But you've got to make sure that that is in there before December 31st. Okay, the next one, TFSA withdrawal. This is also a fairly common thing, but not a lot of people know this. And also, a lot of people get confused about rules around deposits and withdrawals. And so I think I've covered that in a video, but if not, I'll make sure that I cover it fairly shortly. But it's important for you to understand that TFSA withdrawals are kind of a sticky part with the CRA. So essentially what this means is that if you are thinking that you are going to need money next year, okay? So just come back to me so you can see me. Let's say you were thinking you were going to need money next year and to spend whatever that might be. You're obviously not going to want to take it out of your RRSP, but you have your tax-free savings account. So what you would do is you take the money out this year. So let's say you're taking out $6,000. Let's just keep it easy for you to understand. You could take out $10,000. We'll use whatever number you want. Let's say you're taking $10,000 out because you expect to spend $10,000 in 2022. You need that capital. And you're allowed to take out money this year, but you can't redeposit it this year. That's just the sticky part. Unless you have a lot of unused contribution room in your TFSA, then you could deposit. But let's say you had filled up all of your unused contribution room, you're totally full there, you have no more room to contribute, and now you're thinking next year you're going to need some capital. So what you do before the end of the year is you take some of that money, whatever you need for next year, and you take it out in this calendar year. And then you just put it in your checking account, savings account, and then spend it when you need it. But now what you can do is in the new calendar year of 2022, you can deposit your $6,000. That's your annual deposit amount, plus the amount that you took out in 2021. So you get to recapture that room. If you have not done that, let's say you just decided to take the money out in 2022. So you deposit your $6,000, same thing you did already, but then you decide to take out $10,000. Well, you wouldn't be able to put that money back in the same calendar year. You'd have to wait till 2023. So it's just a way to manage your tax-free savings account. So if you have any questions around that, please let me know. Contact your advisor and make sure that you are just using, timing of your money properly. I have a question here from Bob. Hey, Bob, thanks for tuning in, by the way. Appreciate your involvement and participation. Here's his question. Adding capital gains to your income and contributing RRSP for higher refund versus selling with a loss to claim these capital losses. Wow, you are just hammering me with the tax questions tonight. I guess I'm in for it because it kind of was year-end tax planning, right? I'm going to get to that a little bit into this presentation. So for anyone that's want an explanation of what Bob is talking about. So adding capital gains to your income and contributing to an RSP for a higher refund versus selling with a loss to claim these capital losses. Well, first of all, Bob, you got to, and anyone is watching, you have to be aware of what your tax rate is to begin with, and what is your need for the capital, and why are you doing this? This is the first thing. Why are you investing in RSP, and why are you doing these losses? It's a good question, Bob. I'm going to resist going into that because I fear that it's going to be too deep for this kind of thing. Maybe I should just do a video on that one. I think that's what I'm going to table that, Bob, for a video onto itself, because that is a strategy that's going to get lost on a lot of people. I'm trying to do more of a general presentation tonight, but I'm going to table that one for its own video. I'm going to love doing that because it's actually a great strategy. Okay, next one. Business owner salary top up. This is actually for any of you who are business owners and you're always thinking about how much money should I pay myself and how should I pay myself? Should I use salary? Should I use dividends? Should I use both? How much is too much money? There's actually a reason for why you'd want to pay yourself a salary, and there's a reason why you'd want to pay yourself a certain amount of money. So consider paying yourself at least $61,600. This is the 2021 YMPE. So what you're really trying to do is to maximize your Canada pension contributions. This was a video actually that I was going to be doing for tomorrow. So pay attention to that. That's really like a secret, maybe a tip as to what I'm going to be talking about in this video. And that is how to understand CPP benefits. So if you're young and you're working, you're not really thinking about retirement. You're actually thinking about how do I make more money, because it's really expensive to live right now. But the issue here is about contributions to your CPP. Your CPP, how much money you're going to get in retirement, is linked to how much you've contributed. I'm not talking about if you contributed, if you made $200,000 a year versus somebody who makes $20,000 a year. The maximum contribution, so Canada pension, when you get an income, so much of your income is going towards Canada pension. You'll see that as a deduction, right? And so part of that money is being set up for you for the future. It's actually going to pay the people who are receiving benefits today. But the idea here is $61,600 is the maximum that the government calculates to put the money into your Canada pension plan. Anything above that doesn't contribute to your Canada pension plan. So if you make more than $61,600, it's not going to make any difference as to how much money you're going to receive in your Canada pension plan. So you got to make sure that your income is at least $61,600 so you can be eligible to get your maximum Canada pension benefit when you retire. So at age 65, if you've always paid yourself $61,600 and you've qualified under all the other conditions, then you're going to get your maximum benefit. The trouble is when you're younger and you're working for a lower wage, that lower wage, you're not contributing to the maximum amount on your CPP. And so what would happen is that you would actually have a lower payout when you go to retire. So this is really important. So for all of you new people to the employment, make sure you're going to negotiate to have at least a $61,600 income so that you're always contributing the maximum to your pension. Now, the next thing you want to do is now I also go into a video, which I can't link in this. Obviously, when this video is done, I'm going to link the videos in YouTube afterwards. But the issue with business owners is how much money do I pay myself? Why am I stealing money? And I say stealing just from a point of view, you have to understand your capital needs for your business. And can your business afford to pay you more than the $61,600? And why would you want to pay yourself more than that? But you have to examine, can your business pay more? And if it can pay more, here's one of the reasons why. Now, you've also heard me in some of my presentations, some of the videos, I'm for RSPs in some situations, and I'm not for RSPs in other situations. It really is an individual situation that we examine every time I'm in front of somebody. Sometimes it's using life insurance to invest in life insurance over using RSPs. And sometimes we have no choice. We have to use RSPs because there's certain qualifications to do other things that you wouldn't be able to do if, let's say, you weren't incorporated. You couldn't do an individual pension plan. It need to be incorporated. So there's always these different conditions that you have that help us to understand which is the best investment for you to choose. But if RSP happens to be the best investment for you to choose, then you'd want to examine paying yourself at least $162,278. Why do I say that? Because that is 18% of $162,000 is your maximum RSP contribution for 2021, which is $29,210. That's one of the reasons why you'd want to pay yourself at that limit so that you can contribute your maximum to your RSP. So these are things that you want to be talking to your advisor this month, talking to your tax professional as well, and being able to coordinate what is the best thing for you. And remember, it always goes back to this thing, that financial plan. Why are you putting the money into which investment, the amounts, how much? Your financial plan spells out that, and it gives you the answers to why are you doing these particular things. Okay, so this is very important. One question here, let's see what this question is. Okay, this is just something from Bob. Bob, I look forward to seeing your questions when I post that video specific to that strategy, because it's a complicated thing, but it's important for us to get through that as well. Okay, RSP contributions. Everybody thinks about RSP contributions in the first 60 days of the year, and it's really important actually for you to be thinking about it. I don't want to say all year round, but if you're the kind of person who does monthly contributions to your RSP, that's a good thing, because you get to do what's called dollar cost averaging. Basically, that's you lowering your cost of investing over time. So it's a good strategy to do. But if you are one of the persons that does the lump sum at the end of the year, because you look at your income and then you say, okay, how much money do I have available to contribute? Again, it should go back to your financial plan to help you to understand how much you should be contributing. But what you want to look at is your RSP contribution. Make your RSP contribution now. And the reason for that is you have more time of your money being invested. Remember, RSPs are a tax deferral solution, tax deferral product. And so it's time and time value here. How much money can you put in over a period of time and have tax deferral? That's the thing. So if the money is just sitting in your savings or checking account, it's not doing any good for you there. And so you got to get that into your RSP as quickly as possible. So one thing to do is get the money in now versus the first or second or third day of January or the first 60 days of January. The same thing applies if you want to make your maximum contribution to your RSP. You have to have $162,278 income in 2021 to be able to contribute the $29,210. Okay, moving right. How are we doing so far? If you like this content, please follow, like, and share everything that you are hearing about tonight, because it's important. I love sharing this kind of information with everyone. Education is really a big thing for me. I love to educate my clients as we go along. Convert your RSP to a RRIF by age 71. Well, that's kind of, I mentioned that earlier. You have until age, if you turn 71 this year, it's important that you make sure that you convert your RSP to a RRIF and that you contribute your last payment to your RSP. And some people have asked me, should I contribute to an RSP in the last year before I retire? And the answer is yes. Remember, time, you're not using all your money. And if you're still working and you're retiring at age 71, make your last contribution to your RSP at age 71, because all of that money is going to be growing on a tax deferred basis. Okay. Next one, make charitable donations. Now more than ever, people have got so much money moving around. I know it's expensive in the GTA, at least, and in Toronto, it's kind of expensive, but people have made a lot of money this past year in their accounts. And I think it's fair for you to think of not just out of your generosity and wanting to elevate the poor. It's something I heard before is you want to change the world, elevate the poor. That'll make a big difference in your community. But you're getting donation tax credits as high as up to 54% you can receive on your donation. So this is actually a very powerful thing for you to do in this time in the holiday gift giving season, is think about what a charitable donation will do for your tax bill and how it's going to elevate the poor and help people with their standard of living. Contribute to a registered disability savings plan, an RDSP. I have to tell you, this is really close to my heart. I love RDSPs. I think they're one of the most powerful planning tools that you can deploy for anyone who has a registered disability. Now, I'm not going to get into this. I'm actually doing a video on RDSPs because it's a big topic. But registered disabilities, in a nutshell, what it does is it allows for you to establish it's kind of like an RRSP, but not quite, but in the sense that it grows the money in a tax deferred way. So let's say parents have a child that has a registered disability. So in essence, if you are a parent and you are receiving a tax credit, you can be eligible to start a registered disability savings plan. So this is after-tax money, similar to an RESP, after-tax money that you're contributing to your registered disability plan, depending on your tax bracket, like how much income you're making. There's different levels, and you get grants from the government that are deposited into the plan, which are very powerful. This money grows on a tax-deferred basis. You can contribute up to $200,000 over the lifetime of the individual. There's rules around when you have to stop contributing and when the grants are come into play. But if you pay attention to the video that I'll be making on that, I'll explain it in great detail. But what I love about this is it not just for the parents to establish a savings plan for their child, but it's also an estate conservation tool. A lot of people don't know this about RDSPs, and that is when a parent passes away with a child, and the child can be an adult child by this time, but a child that has an RDSP plan, their RSPs that they didn't use in their lifetime on the last surviving spouse would roll over into the child's RDSP on a tax-free basis. The whole amount of money goes into that child's RDSP. Such a powerful estate planning tool. So this is why I think it's important, because a lot of people pass away with RSP balances, large RSP balances, and they have children that had disabilities. And what would happen is their RSPs would be fully taxable in the year that they passed away. They'd lose about 40% of that money to taxation, and then the rest would go to the child in a non-registered account. Of course, they could fill up their tax-free savings account, but the rest of it's going to go into a non-registered account. And then they have to pay tax on the growth of that every year versus it going into an RDSP. It's a powerful, powerful estate planning tool. So I would encourage you to look it up. If you have any questions, send me messages and I'll be happy to help you with that as well. Let me just have a quick look at some of the questions here. Okay. Moving on to the next. This I got to share with you. You're going to love this slide because I don't want to move away from RDSP. I want you to see this slide. Nope, don't have it there. So I'll tell you what it is. How do you tell me an investment that has your contribution of $1,500, that's $1,500 into an RDSP that turns into $5,000 overnight. Show me an investment. I'm not talking about the growth. I'm not talking about putting it in something and it going up in value. I'm talking about you deposit $1,500 and it turns into $5,000 overnight. That happens in an RDSP. because the grants that come into the RDSP from the government are about $3,500. Depends on your tax rate. But I think if your income is less than $100,000, you're going to receive $3,500 in grants from the government. So you contribute $1,500 every year and you get $3,500 from the government. What kind of investment can you do that actually competes to that? That's a remarkable thing. So anyone who has any children that has a registered disability, please look into RDSPs. Okay, and we are on to the last slide, individuals with changes to tax rates. This doesn't necessarily mean that you're a business owner. What it means is 2021, 2020, think about those years. And I'm speaking to people, you know your own situation where you were out of work, unemployed for no better reason other than the fact that your job just wasn't available to you, and you somehow didn't qualify for the benefits coming from the government. And so you're out of work. And now that the economy is picking up and companies are beginning to employ people, you may have gotten a job maybe in November, maybe in December. So your tax rate was actually very low this year as compared to next year when you're going to be in full employment. So now is the year, you have 3 weeks to decide on what kind of decisions you should be making in and around. Should you realize, and this goes to Rosemary's question, should you realize capital gains this year or in 2022? Should you realize your capital loss this year or put it into a different year? These are all decisions you make with your accountant. So one of the things that I'll just share a couple of things. So let's say that you started working in 2021, maybe late 2021. So obviously you didn't pay a lot of income tax because you didn't have a lot of income. So this year is going to be a year in which you have very little income. So this might be that time where you would sell some of your investments that it would have capital gains so that you'll pay less taxes on them, versus selling them in 2022 when you're in full employment and your tax rate went up. You're going to pay more to do the very same thing. So these are strategic ways for you to think about how to use some of the assets that you have. And similarly, if you're expected to have, let's say, a lower tax rate in 2022, well, that's when you would also want to start thinking about selling investments that might have capital gains, or if you're paying like distributions of dividends to managers or owners of corporations. These are all places where you'd want to make sure you're using the different tax rates to your benefit to either sell investments. It's really important that you talk to your accountant because it could result in thousands of dollars in savings for you. Well, I think we're done for the night. I hope you got a lot out of that. Again, I'm on live every Wednesday at 7 o'clock in the evening. Next week will be the last live stream for the year, and then we'll resume that in January. Of course, stay tuned to my YouTube channel because I'm still going to be posting YouTube videos. That won't go away. I've got a bunch of different subjects lined up as I talk today about RDSPs and how we use capital gains and capital losses. The Canada Pension Plan, those are 3 right there that are already lined up and ready to go. I look forward to hearing your questions and comments in the video. Please remember to hit the follow and like and subscribe buttons depending on which channel you're watching this, as it is live streaming on Facebook, YouTube, and LinkedIn. I look forward to seeing you again in the new year or next week. And please, again, head on over to my YouTube channel for more videos. I'm sure you'll like that. And I always end all of my sessions by saying, we take care of your wealth management so you can take care of what's most important to you. I firmly believe that. I think it's so important that you spend time around the people that you love and care for. And my contact information is there. We have one more question. No problem, Shane. I look forward to seeing you next week. And perhaps I'll send out a reminder via email so that everybody remembers that I'm going live on Wednesday next week. Until then, have a pleasant week, and I look forward to seeing you next week. Thanks very much and take care.